Well, inflation.
Inflation rose there at the highest rate in almost 40 years.
Overpriced housing, overpriced cars, and overpriced groceries. And they all come back to one thing: inflation. Inflation is the rate of the increase in prices over goods and services over a certain amount of time, which leads to the dollar being less valuable and people having less buying power. And this is usually represented on a monthly basis by the CPI, or the Consumer Price Index. The CPI is a number that comes out monthly and indicates how much goods and services have gone up over the last month. And in 2022, we were seeing CPI values as high as 1% every single month. When we see inflation increase like this, it directly affects every single one of us because it affects the money in our pocket. Between June 2021 and June 2022, we've seen an increase in inflation of 9.1%, which means your money is 9.1% less valuable. The $100 you had stored away is only worth $91 now. And over that year period, it seems like everything was rising in price, except Arizona iced tea. Seems like that's the only thing that's inflation proof. And the reason for this inflation is really a complicated matter, but it can be boiled down to a few things. The first one was the major supply shortages that we've seen all over the country and then all over the world. During the pandemic, we saw companies shut down, production lines shut down, we saw chip shortages, which means less supply, and more demand means higher prices. We've also seen monetary packages of almost $5 trillion incorporated into the economy over the pandemic, and we know when the money counter goes burr, there's more money in the economy, which means every single dollar is worth less since there's more of it. We've also saw the Federal Reserve reduce their interest rate to near 0%, which makes it practically free to borrow money. When it's cheap to borrow money, people tend to spend more. We also saw many global factors that played a part in the supply issues, which further increased prices. But luckily, after the 2021 and 2022 inflation craze, we saw inflation slow down in reports of October 2023, as we saw inflation numbers go unchanged, which means in the last month we've seen a 0% increase in prices, or overall prices I should say. See, this 0% change also breaks down further into the prices of houses, prices of cars, food, gas, and everything else you can think of. So we did see some prices rise and some prices fall. We saw food rise 3.3%, shelter rise 5.5%, but on the other hand, we did see fuel oil drop 21% and used car prices drop 7%. So this 0% really represents a balance of all items. Some of these go up, some of these go down, and in turn we end up with a 0% change of all items. And this is really due because all the changes that the Federal Reserve done. See, the Federal Reserve is the nation's central bank and is in control of printing the money. They're also in charge of the federal fund rate, which is the rate that banks will charge each other when lending money to each other. So if the federal interest rate is higher, this makes it more expensive for banks to lend money, which makes it harder to get a loan or take on debt. On the other hand, if we want to stimulate the economy like we saw during the pandemic, they will actually lower the interest rates, which makes it easier to borrow money and cheaper to borrow money. But in this last year and a half, we've actually seen the Fed trying to slow down the economy, so they've raised the interest rates from near 0% in February of 2022 to a high of 5.25% in September of 2023. We've also seen a relief in supply chain pressures, which adds more supply into the economy and makes it easier to buy things, which reduces prices. It seems like things are going great. Inflation is slowing down. We might as well just have prices go down. Why don't we just have negative inflation? That seems amazing. Well, what you're explaining there is actually deflation and could possibly be worse than what we're seeing with inflation. See, deflation is when prices actually continue to go down and we see the dollar become more valuable and people's buying power becomes more valuable. See, the reason why this is bad for the economy is because during the deflationary period, we'll see people start to hoard onto their money and spend less. And when we see less spending in the economy, it's actually bad. When people hold on to their money expecting it to get more valuable, they spend less, companies are forced to cut spending, which in turn leads to less innovation, less investments, and more layoffs. And then next thing you know, we're in a big recession. So what actually causes deflation? Well, the first thing that causes deflation is what we're seeing over this last year, and that's the rising of interest. By raising interest rates, it makes it harder to borrow money, more expensive to borrow money, which makes people want to spend less, which means less stimulation of the economy, less demand, and prices go down. In just the last year and a half, we've seen a sharp rise from 0% to 5.25%, which did a good job at slowing down inflation, but now if we slow it down too much, it's actually going to cause deflation. The next thing that could lead to deflation is a banking crisis. In March of 2023, we've actually seen 3 US banks fail due to bank runs. These banks sold their assets at a loss, which in turn made the depositors worried because this bank isn't going to have money for them, which in turn forced everyone to withdraw all their money at one time. And when the bank isn't liquid, that's when banks fail. And if banks see other banks fail, they're going to want to be more restrictive with who they're lending money to, which in turn slows down the economy and causes deflation. Aside from the large contributors like bank runs and monetary policies, Things that could also cause deflation are things like overproduction. When you have too much supply and not enough demand, prices tend to go down. There actually are a few historical examples when we've experienced deflation. And the first one, which is the most notable, is during the 1930s when we experienced the Great Depression. During the Great Depression, from the years 1929 to 1933, the United States economy saw a deflation rate of 7% annually for those 4 consecutive years. This was caused by the collapse of the banking sector and the financial sector. And in turn, we actually saw a 30% decrease in GDP, which obviously isn't good. We want to see an increase of GDP, which means people are spending. Japan has also experienced what's called the lost decades between 1990 and 2010. During this 20-year period, they only saw a GDP increase of 0.05% every single year. And again, this boils down to the lack of spending and the monetary policies that Japan experienced at the time. And because of all of this, the Federal Reserve has been designated the lucky people who are in charge of balancing inflation and deflation. See, inflation actually isn't bad for the economy, it's actually healthy for the economy when under control. When it's runaway inflation and starts to be uncontrolled, that's when it's scary and unhealthy for the economy. But in order to maintain a healthy economy where people and businesses are flourishing, the Federal Reserve targets an inflation rate annually of 2%. And based on November's number, we've come down from a high of 9.1% last year to 3.2% this year. And aside from increasing and decreasing interest rates, the Federal Reserve will also do things by controlling the money supply by buying and selling securities. Another thing they try to do is every month they'll try to give some guidance on where they think the economy is going in order to not keep the public in fear and uncertainty. That job is for the news, not the Federal Reserve. But while interest rates stay high, I think we'll continue to see a decrease in inflation up to that 2% inflation rate that the Federal Reserve is targeting. And once we get to that rate, maybe sometime next year, we'll start to see some interest rate cuts. The economy in the United States and all over the world is a cycle. We're going to see its ups and we're going to see its downs. And we also need to realize that this is just another one of those bumps in the roads. Soon enough, we'll have a happy and healthy economy, and the fear will be gone until the next pandemic or the next issue that the news can find pops up. So over this next year, it's important to pay attention to things like inflation rates, interest rates, and where to invest your money. And you can do all that by subscribing to this page and liking this video. And with that being said, guys, thanks for tuning in. We'll see you guys in the next one.